Welcome to this video on market outlook. This is the first of kind of video I can say which I have posted in all these years in social media, where I talk a bit more about the market outlook or the market present scenario, or what I feel should be doing going forward. Kindly read this disclaimer fully. The contents of this video is not aimed to time the market, or am I predicting any crash or dooms in the coming days or months. This is not a suggestion to sell the stocks and sit on cash, nor a suggestion to wait without investing. I may be completely wrong, but let us discuss. Share your views with facts and not emotions. The contents of this video is aimed to create some awareness for you to tread carefully in the coming days. A brief background about this video contents or this work. Based on an idea inspired by Guy Spier that he and like-minded investors meet once in a quarter or periodically, and they discuss the stock ideas or the situation investing scenario. Similar thing I rolled out somewhere in 2017 with my friends, where we have a get together once in 3 months or 6 months for a dinner in somebody's house, and we do a short 10 to 15 minute presentation across various topics. Pre-COVID, there were many such get-togethers, and the main focus was on technology, but I always used to stick to investments or personal finance. In this COVID times, we never got a chance to have such a gathering for the last 2 years. Nearly after 2 years, recently, a few like-minded investors and friends had a get-together, and the discussion was focused mainly on the markets. So whatever I have brought out here is a collective view from my friends and other peers who joined this discussion. First topic which I would like to discuss is liquidity. Post March 2020, there has been a surge of liquidity. If you see, in 2008, there was a financial crisis and there was a breakdown of the banking system, and there was a huge carnage in the stock markets, and finally, as a only measure, government injected liquidity to bring back the original situation. But by then the carnage was done. But in 2020, it was a health crisis and there was a painful journey ahead. So probably governments did not want an economic pain as well. So the liquidity option was chosen once the market carnage was started. This is very clearly visible from the market steady recovery post March 2020. If you see the graph, the first blue line shows the liquidity injection during the financial crisis in 2008. There has been some increase, but there were all good times, no crisis. But March 2020, immediately after the outbreak, you can see the steep increase in liquidity by the US Fed. So what this means for investors? Too much money is chasing stock markets and cryptos. So liquidity is one reason for the sharp rise in stock markets. So let us invert the situation and see. How would you have the situation been without COVID? So if there was no COVID, there would be no average liquidity like how we have now, and market may not have reached the current heights. But I agree humbly that it is difficult to predict or see the alternate history, what if. And as Shankar Narayan puts rightly in one of his interviews, the current bull market is driven by developed world central banks, and a 5 minutes announcement from them on any day can bring down the markets very steeply. Will it happen? When will it happen? And what will be the impact? These are all the unknowns. This is the notes of the video from Mr. Shankar Narayan, I have shared the link of that video in my description of this video, where he primarily touches upon the idea that till 2008, stock markets and banks were running separately. But now, stock market exists at the whims and fancies of the developed world central bank. If one statement US Fed makes tomorrow, stock markets can come down very easily by 20%. But it doesn't necessarily mean that it will fall tomorrow itself. But when, none of us know. Nothing can be predicted about future, but as investors, we should bear about this risk while investing in bull markets. So, what is the outcome of such huge liquidity? When the liquidity is high, the inflation or the prices go up. It can be very obvious, like what you buy something for today, say 10 rupees, in 1 year it starts selling at 12 to 13 rupees. In US, this inflation has been all-time high, which is reflected from the first chart. And this is expected globally. It's not a phenomenon in US alone. It's expected globally. And to counter this, now banks will start or will have to start increasing the interest rates. And the other possibility is the quantitative easing, or also so called the Fed taper, which means they are going to reduce the liquidity, which the US Fed has already declared. Starting end of November, they are going to taper the liquidity. So this corrective action will have impact on the stock markets. But when, how much, we don't know. Before moving to the second idea on greed and fear, I want to invoke or recall some of the messages by Howard Marks. As most of you know, Howard Marks periodically writes some memos and publishes in his website. In his 2004 memo, Howard Marks has mentioned that markets fluctuate between greed and fear. So it is not difficult to find out which phase of the market we are. Why? Because either the greed or the fear dominates, and accordingly they move the markets dramatically. If there is only greed and no fear, what happens? Everybody wants to buy, nobody wants to sell, and very few people can think that the prices should not have gone so high. So why this greed and fear cycle comes? That is because of the change in attitudes of the investors towards risk. When greed is prevalent, investors are comfortable with the risk, or they forget the risk completely. They are willing to take high amount of risk. On the contrary, when fear is prevailing, investors are very much risk averse. We feel that now currently the market is on the side of greed, and this decision or view is based on some observations which we will discuss further. The first one is the exponential increase in the market participants over the last few months, be it either traders or investors. From the period from 1986 to May 2020, it was 35 years where BSE had around 5 crore accounts, which could be investors or traders. And the 7-month period from May 2020 to Jan 2021, 1 crore new investors were added. And this year, 2021 up to September, 2 crore investors were added. So why these 3 crore investors who did not turn up prior to May 2020 got into the markets? Was it a fear of missing out, or the confidence of making easy money easily? We don't know. We don't have the right answers. But while this is a good thing, more and more people participating in equity markets undoubtedly is a good thing. We are not saying that people are greedy. But have the participants come with the right knowledge for trading or investing? Have they come with the right expectations, return expectations? Are they aware of the risks involved in equity investing? So let us delve a bit more into these questions. So to understand why these new market participants came into the markets or their mindset, we just discussed with a few friends or relatives, peers and neighbors who entered this market in the last 18 months. So one thing we come to know was there was no fear of risk in investing nor losing the money permanently because they have not gone through the stage. Second, many of them were using some kind of leveraged money. It was not their own money. It was either the savings of their parents or what they got as inheritance, the easy money. In one case, a person wanted to use the savings of his father meant for his sister's marriage so that he can double it in a few months and give back the huge amount to his father for his sister's wedding. In another case, a person got some inheritance, say 30 lakhs or 40 lakhs, which he wants to put it in the market and make it 70, 80 lakhs and use it as a down payment to buy a good villa. So these were the kind of expectations with which people were coming in, and none of them had a long-term horizon and focus was on trading. While I'm not going to comment whether trading is good or bad, but they were not even having the required skills or knowledge about trading. They only strongly believe that money can be doubled in less than a year. And they have no idea why they are picking up a particular stock. Their decisions are purely influenced by recent price performance or the gurus from the business channels or Twitter handles. So we summarize that many people came for quick money with little or no basic knowledge of either investing or trading, which is really a dangerous scenario. Also, there were too many IPOs in the last few months. Nothing wrong about it. Coming for an IPO is not wrong, but most of them were having outrageous valuations and almost any price was justified and a very strong defense for such valuations in social media, of course. Even if I remember, one of the case had some past dubious management activities. Even that IPO went through at a very crazy valuation. So we ask ourselves, why so many IPO now? So it's a part of greed from both the management and the investors, is it not? See, the management wants to cash this opportunity to spin out their company at a highest possible price. And investors or traders, whoever, they also want to make a quick bucks. The third aspect which I would like to take up for discussion is cryptos, the most widely debated and discussed topic recent years. Till a few months back, if there was one stock which was very hot in social media, it was ITC. There were supporters as well as people against that stock. But now, cryptos have taken that place. Going by the recent ad in a full front page ad, we can see that there is nearly 6 lakh crore money invested in crypto assets, and India has more than 10 crore crypto owners. Looks like too many investors and too much money is in this asset. I try to understand, so I don't want to keep away saying that it's a bubble or something. I try to understand, and I could technically understand what is cryptos and what is Bitcoin all about. I could understand that, but I could not get answers to questions like, what is the risk involved? There were too many unknowns. 2, what moves the price either up or down? I could not have an answer. One common thing which I find in social media is old gen people cannot understand this. But why not a simplified and understandable explanation so that old gen or anybody can understand about this asset? Because we are talking about something like a future currency, all must know about it. Otherwise, the landscape is incomplete without having the so-called old gen people or a major population. A few aspects about cryptos which looked interesting and felt should be shared will be discussed now. The first one was one tweet from a person, none other than Elon Musk, could bring down or take up the value of cryptos. It seems somewhere in May 19, the entire crypto sector had lost close to $1 trillion. And once Elon Musk had barely put a two-word tweet or something with two emojis, the value again increased. This is something which is really not comfortable with. Cryptos. The second aspect within cryptos is the energy consumption by this Bitcoin transactions. It is estimated that a Bitcoin transaction consumes around 81 terawatt hours annually. If Bitcoin was a country, it would be ranking in the 39th position in the usage of power. And if you see the Bitcoin average consumption per transaction is several times higher than 1 lakh transactions of 1 lakh Visa transactions. The same goes to this table where you can see the kilowatt hour carbon emission and the gallons of gas needed for different transactions, right from the paper currency below to Bitcoin. You can see just a steep exponential rise. With one side, we see there is energy shortage. We talk about conserving energy. Another side, a cryptocurrency consuming so much energy for its transaction. So where would this lead to in future? There's something not known. The last most important aspect about cryptos is the action by regulators or the government. If you recall, in 2018, India had banned the cryptocurrencies or trades. And recently, it was revoked back in 2020. The ban was revoked. And currently, in the last few days, government is discussing to regularize these crypto trades. They are planning to introduce some bill or have some discussion in the parliament. We need to see how this turns up. The last aspect is, in the recent times, the participants have forgotten many basic tenets of investing. The first and foremost, valuation. The consciousness about valuation is completely gone. For example, there are a lot of tweets saying 10 stocks worth for the next 10 years or long-term investing. Some around 10 to 15 stock names are there. While a few are good names, not all are. And even within the good names, the valuation part is completely neglected. And even if you see the recent IPOs, the valuation was really outrageous with even 4-digit P's. I don't support the theory of P because P is not a proper valuation tool, but still a 4-digit P is a way too high. People have forgotten that quality of business and management is very, very important for long-term investing. People don't even question whether that company or business is making money. Most important, it seems that people have forgotten that markets can also go down. It's quite possible because since most of the participants joined after May 2020, and from that time on, the prices of, the stock markets have been steadily increasing. Most of the participants are anchored to the fact that markets can only go up barring a few bad days. The fact that markets can go down is not known or completely ignored or forgotten. So this discussion was with some few, to be precise, it's around 6 members, a mix of peers, friends, and like-minded investors. So what we proposed to do was, let me clarify, this is what we propose to do. This is not a recommendation that you should do this. What we propose to do based on the inferences from these discussions so far is closely watch for any developments that could have impact on the markets for the next 6 months starting from November 2021 to April 2022. And as part of risk management, we are not going to make any aggressive moves, and we are content to miss any opportunities or any kind of great returns on stuff which we do not understand presently. And we are not timing the market. We are not going to sell our position and sit in cash, but stay committed to our long-term investment philosophy on quality companies. Rather, we are going to load up with cash to capitalize on any opportunity that the markets might throw in the 6 months period from November to April 2022. And most importantly, we are not going to be leveraged. Thanks for watching this video. Please do share your views and comments in the description section with facts. Thank you again.